Hey everyone, today we are going to go over 10 investing terms that you should know. When you are beginning and investing, these terms are so important. So I chose the top 10 and let's dive right in. Hey everyone, this is Lauren Mack with Hacking the Rat Race, and I would love for you to hit the like button and subscribe so you don't miss any more videos on money, saving, and investing. All right, so we're gonna jump right into the 10 investing terms you should know. And the first term is asset allocation. An asset allocation is an investment strategy, and it's basically how you have your assets allocated, oftentimes to minimize risk or possibly to increase returns. So asset categories are things like stocks, bonds, cash, real estate, basically these different areas where you are allocating your assets to come up with an overall investment strategy. So when you hear someone talk about asset allocation, that is what they are talking about. Just your overall investment strategy and what different assets you have your money invested in. The second investment term you should know is bonds. And when you're purchasing a bond, essentially you are loaning a company or government entity money, and you will have a stated term, generally a stated interest rate. And what will happen is you will loan, let's just say $10,000 over that period of time. And during that period of time, you will be earning interest. And at the end of that term, you will be getting the money that you invested back. And again, as long as the company or the government entity, whether that be a municipality or city or whatever it is, as long as they don't go bankrupt, then bonds are usually a more safe investment, simply because you're investing that money and assuming nothing bad happens to that company or entity, then at the end of the term, you'll be getting your money back. So oftentimes bonds have lower interest rates because they are a much safer investment. The next investment term you must know is stocks. And basically when you purchase a stock, you are buying a tiny little bit of ownership in that company, and then over time, depending on how well that company does, then the stock could increase or decrease, which would increase or decrease your investment. One benefit of stocks is the fact that it's more liquid. You can buy and sell them more rapidly. So unlike a bond where your money is in that bond for a stated amount of time, stocks can be bought and sold more rapidly, therefore your money is more liquid. The fourth investing term you must know is a mutual fund. And a mutual fund basically is a fund of several different things. That could be hundreds of stocks, that could be, say, stocks and bonds and cash. Just depends on the type of mutual fund. Mutual funds are professionally managed funds, and oftentimes things like your 401k plan are put into mutual funds. When looking to invest in a mutual fund, it is just really important that you're looking at how much does it cost to run that mutual fund, who is running the mutual fund, and again, what is inside, what makes up that mutual fund. So when looking at different mutual funds, those are some things that are really important to pay attention to. The fifth investing term you must know is ETF, and that stands for exchange traded funds. And basically, exchange traded funds are very similar to mutual funds in a lot of ways. However, they can be traded like stocks on the stock market daily, because with mutual funds, basically when you purchase a share of a mutual fund, you're purchasing that share at close of business. So when the stock market closes, whatever that share is worth at that time, that is the amount that you purchase. However, with an ETF, it can be traded like a stock. So if that amount goes up or down or changes, then you can take advantage of that. Whereas with a mutual fund, you'd purchase it at the time of closing. And some other differences between a mutual fund and exchange traded funds is oftentimes, not always, but oftentimes exchange traded funds are looking at things like indexes, which are much simpler to manage. Therefore, the expense ratio, which is the amount of money it costs to operate these funds, is oftentimes much lower. The sixth investing term you must know is index funds. And index funds are one of my favorite investment types, but essentially an index fund is just a piece of a market. It could be like the S&P 500, for example, which is just the top 500 largest companies trading on the stock exchange. And there are so many others. Literally, there are index funds, there are bond index funds, there are REIT, which is real estate index funds, there are international. Pretty much any slice of the market that you can think of most likely has an index fund. And the great thing about index funds is it diversifies your risk. So for example, with the S&P 500, you're still investing in stocks, but you're investing in 500 stocks instead of one stock. So if one of those companies has a problem, or even 5 of those companies say has a problem, you still have 495 other companies to keep things going. So this is a great way to invest in the stock market and also diversify your risk. So an index fund can be purchased with a mutual fund or an ETF. And again, there are pros and cons to both, but the exact same index. For example, the S&P 500 can be purchased as a mutual fund as well as an ETF. So you would just have to compare the pros and the cons and talk to a financial advisor about your situation and find out which one would be the best for you. The 7th investing term that you must know is target date fund. And this is oftentimes you'll find these with 401ks or with an IRA, for example. And what it is you just put in your projected retirement date. So whatever that is, 2023, 2045, 2070, whatever it is, whenever you're going to retire, you just put in that date. And then whatever company has put together this target date fund, then depending on how far away or close you are to retirement, the allocations within that fund will change. So if you're farther away from retirement, it might be more heavily in, say, stocks, where they can be a little bit more aggressive and you have a longer runway for risk. Whereas if you're going to retire, say, in the next 5 years, it might be moving into more things like bonds, cash on hand, more safer investment vessels, so that whenever you're going to retire in the next few years, that money is guaranteed to be there. And the 8th term you must know is PE ratio, and that stands for price earnings ratio. And this is comparing the company's share price to their earnings per share. And this can just give you an idea if the stock is undervalued or overvalued. However, you should be very careful when only using this measure. If you're looking to purchase a stock, it is a great idea to dive deeper into the company that you're investing in and not just the PE ratio. But here's the thing, a company could have a very low PE ratio, and that could mean it's undervalued and a great deal. But it could also mean that the company is having a lot of problems and maybe isn't doing well at all. So if you were just looking at the PE ratio to make the determination if you were going to purchase a stock or not, then you wouldn't know if this is actually a great deal or possibly a horrible deal. But generally, the PE ratio is kind of the gold standard to gauge where a stock is valued, but you definitely need to do more research and even talk to your financial advisor before deciding to purchase a stock just based on this value. The 9th investment term you must know is prospectus. And in the prospectus, this has all the details you need to know about the stock, bond, mutual fund, ETF, whatever it is that you're investing in. So for example, with a mutual fund or an ETF, in the prospectus, you're gonna find things like the expense ratio, which is how much it costs to run the fund. For mutual fund, who's running the fund, what is in the fund. So if you need all these details, and again, like I mentioned before, you should be looking at the prospectus if you're considering investing in a company and not simply gauging it on things like the PE ratio. And the 10th investing term you should know is dividend yield. So for example, if a stock is trading at $200 per share, and they're giving out a dividend of $10, then the dividend yield would be 5%. So if you're going to be investing in stocks simply for dividends, then this is very important when investing for dividends. Thank you so much for watching this video. Don't forget to hit the like button and subscribe so you don't miss any more videos on money, saving, and investing. Thanks again, and I will see you in the next video.